The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Signs of stability amid the worst stock market drawdown in more than a year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele. Nobody wanting to take the downside to the market headed into the weekend.
Yeah, interesting.
The question, though, is, does this pop actually really last? It's been a very tough week for the S&P. Remember, at one point, we hit the lowest level for the S&P since September. This is now 4 straight weeks lower. That's the longest streak since August. Today, the exception. Equities up by 2 percentage points. The 2-year yield having a little bit of a sell-off. Yields moving higher on that front end. The VIX also calms down. And gold at one point hit that $3,000 an ounce, but it seems like a pause from the risk-off move that we've been seeing, Romaine.
Yeah, kind of interesting because today's rally does not do anything to actually halt what is going to be a fourth week of declines for the broader market. But there is a silver lining out there. While global stock funds saw $3 billion in outflows this week, that's a huge number on its own, but that number is actually minuscule in proportion to the $156 billion in inflows year to date. And that sets up a potential value play, particularly for the Mag 7 stocks, which alone have lost $3 trillion in market value since mid-February, despite leading the pack for earnings expectations for 2025. Hold that thought. Still, even with all the air that came out of valuations, investors were given a reminder of the economic risks this morning. The latest University of Michigan sentiment data falling to a more than 2-year low. And expectations, long-term expectations for inflation, those jumped by the most since 1993.
It is still a little bit too early, but given that we have this wait-and-see situation, both for consumers and for corporates, it does make sense that the soft data should eventually begin to spill over to at least some weakening in the hard data.
The continued souring in economic survey data is why the worst performing stocks this week are in the consumer discretionary space, like airlines and retailers. It's why gold surged above 3,000 an ounce for the first time in history. It's why a Bloomberg Treasury index has outperformed equities for the longest stretch since the onset of the pandemic. It's why the only two of the 11 S&P sectors are in the green this week, and it's why the Mag 7 have trailed the broader market for 4 straight weeks, Alex.
Oh, really ugly superlatives there, Romaine. Let's take a broader look at the Mag 7. This is the Mag 7 Total Return Index. It shows it in market cap. We've seen $2 trillion in market cap erased from value since that peak area that we hit back in February for the overall market all the way to now. And if you look at some of the individual stocks, Romaine, the superlatives are really rough. You're taking a look at Tesla from the same time frame, down 38%. Also, Amazon, Google, down 18%. Meta, down 12%. Microsoft, down 6%. Apple, down 10%. The only stock in the green from the Mag 7 from this time frame is NVIDIA, and that's up just a sliver by about 3%.
Yeah, and the Apple story is really intriguing. That stock sliding about 11% on the week, setting up for what's going to be the worst week for Apple going back to March of 2020. That stock still, though, trading at a premium to some of its mega cap peers. Let's get some insights out of Gene Munster. He's managing partner over at Deepwater Asset Management. And Gene, there are a lot of folks here that are finding some bargains out there in a lot of those big cap names where we were obsessing about their high valuations just a few weeks ago. Well, you got to draw down in those valuations. Are you brave enough, though, to buy into that dip?
I think if you have a perspective of more than 3 months, you should be brave enough to buy into that dip. And I kind of put the context of this. There's the mega caps, and then there's other tech, emerging tech. And I think that both of them will ultimately finish the year higher. So I'm in the camp that this is a pullback. It's so easy for me to get wrapped into the negative headlines and I think lose sight of what ultimately is going on here. And what's going on is that the fundamentals of these companies, whether it's the mega cap or other companies that are powering AI, are better than ever. Even the companies that sell off on their quarters generally have strengthening fundamentals. And we see this disconnect for the first time. And so the reason why I point that out, the disconnect between what the fundamentals are doing and what the stocks are doing, is it begs a question to are you a buyer on this pullback? Are you a believer in what the innovation phase looks like for the next 1, 2, 3 years? And if you do believe that AI is going to have a meaningful change on our lives and these companies are going to benefit and that benefit will accrue to companies outside of tech, then you're in the camp that this is going to go higher. So just to kind of put it all together here, is I still think we are going to be in a bull market this year. I think that Ultimately, we still have another 2-3 good years left of this AI trade. I do believe it will end in a spectacular bursting of a bubble, but I do not think we're seeing the bursting of the bubble today.
Well, on that journey there, though, Gene, and I hear what you're saying about AI spend. And I'm just going to cherry pick a company, admittedly cherry picking here, with Apple, because obviously they have the potential upside exposure from everything that's going on in AI tech. They're also a company that struggled to articulate an AI plan, if you will. They're also a company that, at least amongst the Mag 7, is probably much more exposed to a global trade war, if that is indeed what we're in and what we're going to be for the next couple of years.
So I've studied Apple for a long time, and right now there are 4 forces. You outline those forces. There are 4 forces in play that are pressuring the stock. 3 of those forces: weakness in China. They've dealt with tariffs 7 years ago. There's talk about this softening Apple Watch demand. 3 of those forces are things that they've navigated in the past, and they have pulled through that. And I think the one piece that they have not navigated, the significance of what's going on with their Apple Intelligence initiatives. And I am first to say that I thought this was going to have a bigger impact this year, and just the substance of the product hasn't played out. So this is, I think, where investors should really focus their attention on Apple is, where are they really in terms of getting these AI features out the door? And of course, they just delayed that for a year recently around the Siri, but that's indicative of what's going on with their broader AI initiatives. And so I think at the end of the day is that these headwinds that we're seeing around artificial intelligence is the central question. And surprisingly, I believe that Apple actually has more time to figure this out than many investors are giving the company that room. And the reason is that consumers who have Apple products have a high retention rate, and they're not going to quickly switch to a Samsung phone, for example. If there's an impressive AI feature over there, they're going to probably give Apple some time to figure that out. So I think they probably have a couple years to figure this out. Not good for the stock in the near term, but ultimately they've made a misstep here. They're going to figure it out, and I think that it's going to ultimately result in some upside to the iPhone numbers this year and next year.
Gene, one of the other stocks sort of not in that AI hyperscaler world in the Mag 7, of course, is Tesla, moving on many different things, whether that's sales in China, whether that's Europe, whether that's sales in the US, whether it's pricing, whether it's the White House, and whether it's Elon Musk literally being in the White House. How do you handle Tesla?
So I own shares personally. I think this is probably the best positioned company when it comes to physical AI, which is this next chapter. Jensen talks about the chapter of physical AI coming in starting in a few years. I think Tesla's in a great place with that. But to answer your question is that the near term, I'm bracing for numbers to come down materially. And I'm surprised to see the stock rally in the last few days. I think that the important date is related to April 2nd when we see the deliveries. That's when we're going to get a real sense in terms of how what's going on with Doge has impacted Tesla sales.
Yeah.
And so in general, when numbers come down, usually the stocks go down. I do expect that once numbers get reset, stock sells off, but I think it does climb back. Still a believer that this company has a unique advantage into this physical AI world, and I think they're going to capitalize that in 27, 28.
Gene, but how much do you think of movement in the stock is just due to headlines from Elon Musk and the White House? It has nothing to do with actual Tesla sales. And how does that sort of distort then what we're looking at?
I think what's going on with the stock right now is a shift from the general playbook with investing in Tesla over the last 10 years is there's 2 chapters to it. One is about momentum and the second is about fundamentals. And typically when the focus has been on fundamentals, typically that has had things have been delayed, maybe margins aren't what people were hoping it'd been, and that has been the shift in the stock, that down 38% that you mentioned. It's a move from momentum stock after the election to investors thinking more about the fundamentals. So to answer your question is, I don't think I think the headlines play into this in the sense that it is impacting how investors are thinking about deliveries this year. And in that sense, I think that the fundamentals, again, I think deliveries could be down 5%. And this year, I think most analysts are looking for about 10% growth right now. So I think this is more around the substance to what's going on the demand side.
We only have about 45 seconds, Gene, but is there anything else in the tech space that you like right now?
Well, you mentioned NVIDIA and that being up a little bit, but I just wanted to point one piece out. Jensen had some surprising, shocking, hard to believe commentary about the need for compute on their last earnings call to go up by 100 to 1,000,000 times as we move to more reasoning models. And I'll just say that the work that we've done, we also have a venture business. I think that it really points to that. I don't know if it's going to go up 1,000,000 times, but I think we can build a strong case that it will go up by 1,000 times. NVIDIA is in a great place to capitalize on that. I think that they will comfortably beat the numbers over the next couple of years.
All right, Gene, we should point out, too, of course, NVIDIA has a big sort of a day coming up next Thursday here, and Bloomberg's going to have special coverage of that right here during the close. Gene Munster, managing partner over at Deepwater Asset Management, kicking us off to the close on this Friday, a Friday where we did get an update on consumer confidence, and that confidence is sliding. Pair that with dicey outlooks from several big-name retail brands. Shockwaves now going through the sector, a broad overview of the retail space with Laura Champine over at Loop Capital Markets.
Plus, we continue the conversation on consumer sentiment and the outlook for the U.S. economy with Paul Krugman, Nobel Laureate in economics and distinguished professor of economics at the City University of New York.
The big names, and they get even bigger. How about Erin Lichy? You know her from Real Housewives of New York. Well, she's right at the center of a big conversation that's been brewing now for the last couple of weeks, the impact of tariffs on the alcohol industry. All that and more coming up in just a bit, right here on The Close on Bloomberg.
All right, Pepsi stock is flat today. Bloomberg reporting the company's in advanced talks to acquire Poppi, a healthier soda brand that would value that company at more than $1.5 billion. Joining us now to discuss is the name behind the story that helped break the news for Bloomberg here, Bloomberg's Crystal C. Joining us. What's behind this potential deal?
So the deal is that Pepsi is going to buy this healthier soda brand, Poppi, for over $1.5 billion. It's a big price tag. It's a company that came out of Shark Tank. It's backed by a venture capital firm. But the play here is it's healthier for you. And in the world of Ozempic, people are consuming less. Yeah. They are more selective about what they put in their body. And this is one of those Pepsi's trying to diversify the portfolio into healthier products.
So I've seen these pops everywhere now, not just this particular brand, but all these other things that promises to be healthier.
You said pops. You're clearly from Chicago.
Yes, I mean that's what it's called.
It's
before
called
all you hordes on the East Coast sort of took over our word. But it gets to this idea of, I mean, they call this functional soda, right? So some of it's prebiotics, some of it's probiotics, some of it just has like more fiber or other things. So the idea is that I can feel a little bit better about drinking something I probably shouldn't be drinking. Is that the idea?
That is the idea,
okay.
But there are also some like legal things behind it. Like, can you actually advertise it as a healthy soda? Is it like better for you soda? So there has been some legal debate behind these companies, like Poppi, Olipop. Yeah. They've all have been under scrutiny for advertising one way or the other under like certain language. But the idea is that, you know, you want to feel better while you're still consuming something that you're not supposed to consume, I guess.
Is this a defensive or offensive move then for Pepsi?
So it sounds like Pepsi is very aware. Pepsi, alongside all the other big packaged food companies, very aware of this lowering consumption of so-called junk food. Like with Ozempic, again, like people are consuming less and less, and this very much sounds like a defensive move. But then at the same time, you can see how when people are consuming less, as a company, you're better off like bulking up your portfolio to capture more of that market share. So you can see it both ways.
Well, that's one thing I'm curious about too. Is there anything in here indicative of potential deal activity? And I know companies like Pepsi, really in that food space, a lot of these companies grow primarily through acquiring these kind of small and mid-sized brands here. So should we expect more of this out of Pepsi? Should we expect more of this out of Coke or in its competitors?
Yeah, the big trend in CPG is that, you know, big brands are no longer growing. The brands that are providing the cash flow to all these big conglomerates of food and beverages are no longer going to be the next big thing. Like younger consumers don't want that anymore. So they're buying the growth somewhere else. And that either comes from venture capital portfolio or sometimes homegrown. So actually Pepsi had considered doing their own better for you soda and decided not to do it. Yeah. So now you have this company like Pepsi, Coca-Cola, Mondelez, Hershey, all kind of contemplating where they should take their strategy and whether it's like growing themselves or buying it. So there could be more M&A in this space.
Cheaper to buy than build, basically, at the end of the day, right? It sounds like. Is Poppi into it?
Well, Poppi, we think they're into it. We think the deal is in advanced talks, is in late stage, and it could be announced soon. So we will be keeping everybody in the loop.
All right, Crystal C., who covers M&A for Sierra. A closer look at a potential deal, Pepsi buying Poppy, potentially for about $1.5 billion. And I have a confession here, because she talked about how, I guess, younger people don't want the older legacy brand. You know what I had the other day for the first time in like years?
What?
A Welch's grape. Yeah, don't tell my wife. I wasn't supposed to have one, but I was just out and about.
Like the juice?
No, where? Oh, that's right. I forgot. You're like an East Coast elite. This was a Midwestern thing. Welch's grapes pop.
Oh, yeah.
Yes.
Ew. No judgment, but gross.
Okay. That was judgment.
Although, yeah, all right, fair enough.
All
Well,
right, it was delicious.
Good job.
All right, when we come back here, we're going to focus in on the consumer spending and on retailers and how they performed this earnings season. Waning sentiment and cash-strapped consumers putting a lot of pressure on that sector. But is there a bright spot up ahead? We're going to discuss when we come back. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start out today with Six Flags. Barclays going big on the theme park operator, initiating coverage with an overweight and a $41 price target. The analyst says Six Flags could generate outsized revenue growth over the next 3 years, driven by attendance growth at its legacy parks like Great Adventure and Great America. And while it's too early to call for a recession, he believes theme parks will still fare pretty well against the current backdrop. Six Flags having a great day, up about 8% on the day. Next up, let's take a look at Peloton, getting raised to buy over at Canaccord Genuity following a transfer of analyst coverage. The new analyst calling Peloton, quote, a clear leader in the connected fitness market after building a strong recurring revenue stream from its loyal 6 million subscribers. She's keeping her price target right around $10 a share. The stock having its best day since October. And finally, T-Mobile, a valuation-based downgrade to neutral over at Citi. The analyst, Michael Rollins, believes T-Mobile is generating favorable growth relative to AT&T and Verizon, but says T-Mobile's valuation has peaked and there are no immediate accelerators that can reduce that premium. Those shares heading for their worst week since December, and those are some of our top calls. It's also been a rough week for the consumer discretionary sector. While earnings over the past 2 weeks have been mostly positive for retailers, there were multiple warnings about shoppers feeling the sting of inflationary pressures. We've seen a bit of that being reflected in today's consumer sentiment print out of the University of Michigan. Laura Champine joins us right now. She's managing director over at Loop Capital Markets, covering the retailers. Laura, great to see you here. I know you've been busy kind of parsing through all of these earnings. The numbers themselves weren't awful. But when we got to the commentary on the conference calls and some of the guidance that these companies gave, it seemed to suggest that they are preparing for less spending overall. Was that your takeaway?
That's my takeaway. We just had our big conference at Loop this week, and Lowe's came. And Lowe's had a survey of its pros in January and then again in February, and they can see just that month to month a shift in sentiment, not just for consumers, but also for pros who do work for consumers. It looks like there is a slowdown in discretionary spending.
I mean, how bad does that slowdown look? Are we just talking about a minor blip that, you know, maybe it distorts a number or two in a couple of quarters and then things get back on track? Or is this something a little bit more serious?
I'm hopeful that it's short-term, Romaine. I think a lot of people want to get a sense of where will the unemployment go? Where will uninflation go? Hearing different headlines about tariffs every day is not helping consumer sentiment. But we're hopeful that we get a couple of quarters out, which is what we should be discounting, and we'll see much more stable spending trends.
Right, because they're talking basically about when the vibes show up in that hard data. So the vibes are holding people back, but if the vibes feel better, does that unleash more spending?
We think that it does, but we do think that we ought to focus on value. So Costco, not Kroger, TJ Maxx, not Macy's. So that shift towards discounted spending, we like the cruise lines. They're about half as cheap as taking your kids to Disney World and staying on property. So we think that there are ways to find value in consumer, and that's where we ought to focus.
Do you feel like the warnings that we're seeing come out of this quarter, just in terms of tariffs, is this like the baby bathwater quarter or not yet? Where all the bad news is like, look, we're really worried about this and this is the worst it'll get?
It's tough to know when the tariffs are changing kind of month to month. So at our conference, we had CEOs with their phones on the desk and the tariff policy might change in the middle of a meeting. So we've got to iron that out and find out where we stand. So you don't necessarily want to be an importer. I like the domestic manufacturers of consumer goods, the Whirlpools, Mohawks, Tempur Sealy now calls itself Somni Group. But I think that domestic production and defensive consumer spending is where we want to be.
But how much of a of a moat, I guess, do the domestic producers really have? Because a lot of them are still dealing with inputs that would come from overseas. I mean, you take steel and aluminum. You're not making a washing machine unless you can source the aluminum steel. And I know some of that does come from the U.S., but there's obviously some dependency overseas as well.
Right. So that's why I called out the specific ones I did, because Whirlpool is buying domestic steel. Sometimes they're paying twice as much as their big Korean competitors who can source steel from China. So I think that this shift in tariff does help, but you do have to be selective and look at where the inputs and the raw materials come from. And I think Whirlpool's a good call on that basis.
And that gives me, that sort of raises the issue, too, of how much pricing power these companies will have. If they do get to a point where they don't want to eat the cost, like, we interviewed last week, we had the CEO, or at the start of this week, we had the CEO of Chipotle, who made it clear our costs are going up, but we plan to actually absorb that rather than pass it on. And I wonder how many of these consumer-facing companies even have the ability to do that if they so choose.
Depends on who they are, right?
Yeah.
So Steve Madden, that sells lots of private label into Walmart, not much pricing power. You raise that price of a pair of shoes $2, $3, it impacts demand. For a washing machine that you might buy one every 10 or 20 years, hopefully, I think you can sneak some pricing in. And what they've seen, those big ticket home related purchases, if they lower the prices, it doesn't drive demand. They're basically selling to people who've got a broken fridge in the house. Demand's already at a 40-year low.
When you talk about the suppliers, though, we had that story about Walmart going to their Chinese suppliers trying to negotiate cheaper pricing, the Chinese suppliers then pushing back. What do you make of that relationship or that dynamic for those that have suppliers outside of the U.S.?
You know, it gets worse when, once again, the tariffs change every month. So they went to them when it was 10%, and you can get some mitigation there. Trying to go back again when it's 20%, that's tougher. So we're finding the hard spot in those negotiations where they're just not seeing the mitigation on the supplier side.
So you mentioned TJX, right? Whirlpool, right? So who else do you like in the space?
TJX, Whirlpool, Costco. Part of the reason I like Costco, they're taking share, but also so much of their income comes from membership fees. So that's pretty steady Eddie, looking for defensive places to be.
Laura, really appreciate it. Thanks for coming in. Thank you very much, Laura Champine at Loop Capital Markets. I told you my 82-year-old mom just got her Costco membership.
Oh, did she?
Yeah,
Oh, that's
adding those people as they go.
All right. Godspeed to y'all. Between you and Scarlett and the rest.
Oh, I don't have a Costco membership.
Okay.
My apartment's not big enough.
Can't you piggyback on
No,
on
apparently
hers?
they cracked down on that.
Oh, they
so she
did.
can go and buy me toilet paper, but I can't go under her name and get the toilet paper. But I don't have that kind of space.
Okay.
I live in Brooklyn. You remember? East Coast elite? All right. Coming up, we're going to discuss the economic implications of the global trade war with Paul Krugman, Nobel laureate in economics. Looking at a market here that's right around, a little off the highs, but the S&P is still up by about 2%. Look at that. NASDAQ up by 2.5%, but the volume, though, remains still quite light in this market.
Yeah, we'll count you down to those closing bells. Stick with us. This is Bloomberg. .30 p.m. here in New York. This is the countdown to the close. I'm Romaine Boston.
And I'm Alex Steele. Equities right around the highs of the session. Surprising considering that UMich sentiment data that we got earlier in the day that showed that huge jump in inflation expectations.
And I thought that would really kind of knock a leg out of the market. But I think you saw, given the drawdown that we had in the days and weeks leading up to today, it's understandable why some people maybe are coming back in. We were far into oversold conditions for a lot of the major indices, in particular in a lot of the individual names. That doesn't mean that the economic risk, though, is somewhat gone.
Nope, not at all, particularly when all across party lines there was that longer-term inflation expectation risk. We're joined now by Paul Krugman, Nobel laureate in economics. He joins us now. Paul, it's really good to get your perspective on this. What we're seeing is the soft data and the vibes deteriorate. When does that lead into that hard data? What's the lag time?
Well, if I believe some of what I was here on your own program, some of the consumer-facing businesses are already seeing it, so it probably starts to show. I mean, you got to bear in mind that even, when we get data for March, it'll actually be data for the first half of March, really. And so it'll take a while before it's really in the numbers. But if this is for real, if consumers are as upset as they say they are, this is going to be a pretty heavy blow to the economy.
And that raises the silly question for me of are tariffs actually inflationary, which raises the question, are we in a trade war or a tariff war? And a tariff's one-time cost increase versus a trade war that can be really prolonged.
Well, I think we are in a trade war, but even so, I mean, if it's 25% tariffs on everything around the world. Even that is a one-time pop in prices unless it somehow feeds into a continuing process. And one of the great unknowns here, I mean, there's so many unknowns, but one of the great unknowns is whether it's a one-time hit, whether it's something like a pop in the price of oil, which the Fed ignores because it believes that those don't lead to sustained inflation, or is this something that's going to sort of dislodge, destabilize inflation expectations and end up being a longer-term problem? And I don't know. The point is actually nobody knows, which is part of this environment of extreme uncertainty that is now surrounding everything.
So how much stock, though, should we put in to this type of survey data on longer-term consumer expectations? Because I went back and looked at what some of that survey data looked like in 2017 when we were kind of starting up the first sort of batch of Trump tariffs during his first term here. And you did not necessarily see that type of pessimism so soon in the process.
Yeah, this is kind of unique. I mean, it's actually stunning how fast consumer expectations have deteriorated. I wrote about this on my Substack today. That I thought we would have a few months at least of people feeling good. Great, we've got a businessman president. He's going to bring things under control. But the combination of this, not just the tariffs, but the on again, off again, on again, off again tariffs, the confused rhetoric, and I think also the crazy stuff, we're going to annex Canada, has dislodged people's certainties about the future much, much faster than, I think it's probably a record. I don't think anybody's ever seen them deteriorate so fast under a new administration.
It raises a lot of questions, too, about monetary policy and what effect it can even have in this particular environment, not only given the speed of changes, but as you kind of alluded to, the idea that whatever changes today could change potentially next week, and for a Fed that, at least admittedly, is somewhat a little bit more long-term focused. I mean, how do you even go in there and have an honest conversation about what economic conditions are going to be like? I'm really interested to see their summary economic projections next Wednesday, but how much can I trust those projections given how erratic fiscal policy, or at least I should say Washington policy, has been?
Yeah, remember, the Fed is intelligent people, but who basically have the same information that you and I do. So they're as much at sea as the rest of us. And one thing that I think is special is that the uncertainty, there's on again, off again, who knows what actually, what's going to be posted on Truth Social tomorrow, is itself a force depressing the economy. I mean, suppose you're a business trying to decide on between two investments. One of those investments makes sense if we are actually going to have 25% tariffs. The other makes sense if we don't have 25% tariffs. And if we don't, either investment will be a big loss if you've guessed wrong. So what you probably do is you sit on your hands. You don't invest. This has got to be exerting a depressing effect on business spending, probably on consumer spending. We may not see it in the hard data yet, but we've talked endlessly about uncertainty as a possible drag on economic activity, and measures of uncertainty are completely off the charts now. It's never been nothing, except in the worst of the pandemic. But we're managing, things look fine. Unemployment is low, inflation is still pretty low, but economic uncertainty is at levels normally associated with major natural disasters.
Yeah, I've been hearing from business leaders like it's a pause button for now, not dump projects, but pause. Drilling down into tariffs a little bit here, what part of the rebalancing of the trade routes and the trade balance do we need to actually address? Like, what's legit here?
It's not at all clear that there's really a problem. I mean, for the most part, the U.S. runs a trade deficit. It's the counterpart of capital inflows. It's the arithmetic. If foreigners are investing in your country, then you have to run a trade deficit. And for the most part, the U.S. runs a trade deficit because the rest of the world thinks America is a good place to invest. And it's not clear exactly what the issue is that's supposed to be resolved here. It's also not even clear that tariffs will reduce the trade deficit, because other things being the same, if we import less, that will strengthen the dollar, which means that we will export less. So what they will do is they'll shrink the total amount of trade and raise costs and raise inflation, but not even necessarily do anything measurable to the trade deficit.
I'm glad you brought up the dollar because we do have a wide trade deficit, yet the dollar still remains strong, and that's not counting any of the issues that we're putting on here. Is that a problem, and what do we do about that?
Well, again, if we're at full employment, and and we are, at least for the moment still, there's some hints of weakness, but a full employment economy, it's not clear why a strong currency is a problem. I mean, back when we were a depressed economy in the aftermath of the financial crisis, then the strength of the dollar was a problem. But right now, why exactly are we concerned about it? I mean, we seem to be inventing. I mean, we seem to be inventing problems that aren't really problems. It's kind of like, drug smuggling from Canada, which basically doesn't happen and yet has become central to our trade policy, apparently. So the strong dollar, yeah, I mean, there are some things we could wish. Maybe the U.S. had higher savings and didn't rely as much on foreign capital, but there's no acute issue here.
All right, Paul, going to have to leave it there. Really appreciate you taking time for us. So Paul Krugman, Nobel laureate in economics, professor of economics over at the CUNY University of New York, as we focus in on economic conditions and how it feeds into market conditions as well. It's been a tough start to the year for the software sector. The IGV software ETF actually down almost 20% from its all-time high going back to early December. But our next guest says caution on demand improvement and capacity constraints are two of the reasons holding back those stocks. Will that loosen up? Stefan Słowinski joins us right now, global head of software research over at BNP Paribas Exane. And I was taking a look at the performance. I was actually surprised at how poorly they've done, particularly since I think those broader market highs that we saw in February. What is actually holding back the enthusiasm for these names? Because when I go through the names, there's still big cash generators. All of them, with maybe the exception of 2 or 3, have pretty healthy profits.
Yeah, so as you said, the IGV down 10% this year, actually flat over a year and flat over 3.5 years, going back to that 2021 bubble. So I think at the beginning of this year, we really had 4 C's holding them back. One was caution around underlying demand, not willing to put kind of improvement into the guidance. Number 2 was caution around AI contribution. So even though upbeat on the prospects, not yet willing to put that into the guidance for this year. We also had capacity constraints. So even though demand was outstripping supply, a lot of the hyperscalers disappointed because of capacity constraints. Then finally, you had currency. So you put all that together, and we saw some earnings downgrades. That was January and February. And now as we come into March, we're getting hit with the tariff uncertainty and the impact on the macro.
I do want to let me just take one of those C's there, and that is obviously the whole AI trade, because that was a big part of the run-up that we've seen in the last year or so. There are a lot of people debating whether the AI spend is indeed materially slowing, I should say. We had Gene Munster on earlier. He seemed to think there's still life in this AI trade, and particularly life for some of these big cap tech names.
Yeah, absolutely. And one of the questions we've been getting from investors is how much of this drawdown is kind of macro concern, how much of it is disappointment in AI. Actually, the AI data has been pretty supportive. On the hardware side, NVIDIA and Broadcom, AI demand was still quite healthy. We saw Microsoft 33% growth year over year in their total backlog. A lot of that was AI, $300 billion of backlog. And then most recently, Oracle, we saw 66% year-over-year growth in their backlog, up to $130 billion. So we are still seeing that sort of demand increasing, but it's taking a little bit longer to come through into revenues because of some of those supply constraints. But that could be a catalyst for the second half of the year as those constraints ease.
If DeepSeek means that costs generally come down for AI build-out, what does that mean for the software guys?
Well, if it does, then it would be good for the software guys. And I say if because there's still lots of debate around the cost of build-out. But in general, for the ecosystem, if they can deliver AI as part of their product, then in a cheaper way, then that's going to be good for them. And obviously, it's going to be good for demand as well if they can let that come through in pricing. So if it accelerates the adoption of AI, then it's going to be good for the wider industry.
Which of the companies that you cover is best positioned for this upside?
I think when we look at the second part of this year, again, we don't know what's going to happen in macro, but like I said, if we do get those capacity constraints easing, Microsoft Azure, Amazon Web Services, Google Cloud, Oracle OCI, consensus isn't really modeling any significant reacceleration. So all those companies will benefit almost regardless of macro in terms of demand. I'm not saying it's not important, but capacity availability coming online will help. I think as well, we're starting to talk to investors the last couple of days around the valuations looking more attractive. On the application side, you have companies like Salesforce, Adobe, Workday, all now trading with a 6% free cash flow yield. So we're starting to see really longer-term oriented investors maybe taking advantage of some of the volatility, some of the degrossing we may be seeing from some of the shorter-term investors to kind of find some of these longer-term opportunities and kind of kick the tires and see if this is a good entry point.
Well, and what are the companies themselves saying? I mean, we were speaking with Laura Champine over at Loop Capital, and she was talking about a conference they had on the retail side and how skittish a lot of those executives are right now about tariffs and adjusting to it. You had a conference last week, a TMT conference out, I think, out in California, another one out in London this week. What were people saying?
That's right. We had the BNP TMT Corporate Conference in Indian Wells. This week we had the BNP Technology Investor Conference in London. And it's a holding pattern, kind of as your previous guests were saying, which is on the corporate side, we don't have the visibility because of tariffs, so let's wait until April 2nd and maybe we'll have some more visibility. And on the investor side as well, let's wait until April 2nd. Actually, let's maybe wait until the end of April when we get those Q1 results just to see how much of this uncertainty is filtered into demand. And maybe once we get past that, we'll feel more comfortable playing some of those H2 themes.
So is there competition right now for investor money in this space? And the reason why I ask is we've talked a lot about people rotating to other parts of this market, people rotating to other geographic areas, like obviously to Europe, and we've seen the big run up in defense stocks and even some of the tech stocks over there. Are we at that point where we need to start worrying about competition?
I think we've been seeing that for quite some time. I think on the AI side, these capacity constraints aren't actually new. We've been seeing this now for 9 months. And so investors have been using that as an opportunity or an excuse to kind of rotate into other parts of the market, and that's been hurting some of the mega cap stocks. Of course, in December, it looked like we were at an extreme in terms of optimism around US and pessimism around Europe. So we've seen some reversal of that trade as well as kind of animal spirits have been awakened in Europe, actually, because of some of the pressures they've been under. Yeah. So again, we saw that at our conference in London this week, a renewed interest coming through for European stocks. We have next week maybe the German government coming out with some spending plans. And so that can filter through into tech. SAP is another name that we like that's done well. They're the biggest supply chain software vendor. They supply all of the European manufacturers. So there's even ways of tech of playing some of those trends.
I know, but it's like awakened versus really awake. I feel like it's still a distinction. We have visibility for big CapEx spend through this year, right? But what's your confidence level in that CapEx spend in 2026 and 2027 and 2028?
Well, it depends how you look at it. From my standpoint as a software analyst, we'd like to see that CapEx spend maybe decelerate and come back down so we can feel more comfortable about the returns that we're going to get. But overall, I still think there's a bit of an arms race here amongst the hyperscalers to get to this AGI finding first. So I think we're going to continue to see lots of CapEx spend and growth. I would say Microsoft's the one that's probably running the fastest towards giving us that ROI, meaning we'll probably likely see CapEx growth slow significantly and hopefully simultaneously get that Microsoft Azure growth accelerate in the back half of the year. I think for the other hyperscalers, there's less certainty around the return side of that equation as there is with Microsoft.
All right, so you get the lower CapEx, but you get the return, so then that works its way out. All right, Stefan, thank you so much, and thank you for coming in studio. We really appreciate it. Stefan Słowinski, Global Head of Software Research at BNP Paribas Exane. All right, we are just 15 minutes away from the closing bell after this very volatile week on Wall Street. You're looking at 4 straight down weeks for the S&P. At one point this week, we hit the lowest level for the S&P since September. It's been brutal. Take a look at the spike in the VIX. Even high-yield bond spreads remain starting to widen out just a little bit.
Yeah, I mean, maybe that is the canary in the coal mine, but not quite there just yet.
Yep, Julie Biel, Chief Market Strategist at Cain, Anderson and Rudnick, will be joining us. This is The Close on Bloomberg.
I still think we are going to be in a bull market this year. I think that ultimately we still have another 2-3 good years left of this AI trade. I do believe it will end in a spectacular bursting of a bubble, but I do not think we're seeing the bursting of the bubble today.
Gene Munster over at Deepwater Asset Management kicked us off to the close just about 50 minutes ago here. Stocks holding tight right now, Alex, to their gains on the day. Of course, still going to be down for a week, but I thought the price action was kind of encouraging. I mean, we opened higher and we've pretty much stayed higher and drifted higher this entire session.
Yeah, but hasn't volume been really light, though, at the same time, too?
Yeah.
I'm much more skeptical and pessimistic as a human, so that's how I'm going to be looking at this rally. But yes, 2%, but the upside for the S&P is definitely something.
Okay, so like when you get a pony for Christmas, you're the one that looks it in the mouth and says, you know,
like a gift horse
something,
in the mouth?
yeah.
100%. I'm like, who's going to clean up the poop from the donkey? But also, you take a look at some of the other areas, like the Russell, in a bear market, right? So coming up 2%, 1.5%, that's not doing that much. The equal weighted index, though, has held up relatively well, not down nearly as much as the S&P.
And I think that's interesting, too. I mean, the equal weighted index, and I should point out, too, I mean, the Russell's down on the week. It's actually outperforming, believe it or not, the broader market. It's outperforming the S&P, outperforming the NASDAQ. So maybe that is a sign that there is actually some rotation under the surface, just not rotation into those big cap names that kind of can lift the entire market.
Right, like out of tech, out of growth, out of momentum, and into something else.
Yeah, well, let's see what our next guest thinks. Julie Biel joins us right now, Chief Market Strategist over at Cain, Anderson, Rudnick, with just about 8 minutes until we get to the closing bells. And I do want to ask you about not what people are selling, but what people are indeed buying, because we did see a couple days ago when the dip buyers came out, although they kind of got scared away by the end of the session. Today is a different story. I mean, they were out in force at the open, and they've pretty much stuck with this trade all the way to the close.
Yeah, absolutely. I think today what we're seeing is a lot of tech-heavy buying that, you know, probably were the most beaten up parts of the market in the last, call it 2 months. And, you know, I think that there's renewed interest in going back into those sectors. I think the question really remains is those stocks, though they were quite beat up, they still weren't cheap by any method or standard of valuation. And so the question really remains is how much juice is there left in this AI trade? How much opportunity set is there still available to us? And what does all this mean if we enter into a much softer period of economic weakness?
But are we going to be in a period of softer economic weakness? We've been having this debate for the last couple of weeks on this program. We get this survey data like the UMich data, which continues to show deterioration. But of course, the hard data itself does not necessarily reflect any real material softening. And I understand there's a big asterisk that could change once we get the reports for March, April, and beyond.
Yeah, I think that's right. I think in most cases, the soft data is soft because it's not actually that super useful, right? We often say in survey data that we're not feeling great, but here we are out there spending on shoes and God knows what else I spend money on. And so there's a mismatch there. But I do think that there is a level of uncertainty that's quite unique in this time period right now, where it's not just infiltrating whether or not I'm buying high-priced shoes. It's CEOs questioning, do I want to get out there and spend aggressively on CapEx? Do I really want to be hiring as much as I had originally planned if we're in a protracted trade war? If there's still policy uncertainty, is the government going to stay open? And I do think that pausing mechanism actually creates tangible economic value or destruction of value in some circumstances.
Right, because it's coming from the C-suite and it's sort of that momentum. I even lowered my budget, Julie, my weekly budget. I cut it by a third. I'm just saying, like, it's huge. There's no shoes for me.
Brutal.
I know, it's brutal. So from that perspective, where do you go? What do you sell out of, and then what do you buy?
So, I think we don't want to be taking major actions in terms of positioning because we can't really predict those things. But what I do think we're starting to see is this recognition that, these more persistent, not necessarily defensive companies, but businesses that have a high level of earnings predictability and durability are the kinds of names that seem to be doing a little bit better. And I think this makes sense, right? Because the big question with AI is when are we going to get a return on this level of CapEx investment that has just kind of exploded these businesses? And all of these tech companies have been like, don't worry, the total addressable market is gigantic and you don't really need to worry about a thing. It sort of feels like, when you were like dating those like flashy guys with fast cars, those guys with the sweater vests, nice, sweet guys. Those are the ones you need to be checking out in this kind of a market. And those are companies like a Copart, like a Verisk, like a Tyler Technologies, where they're really dependable, reliable businesses. And I think they're a nice complement to, those faster, flashier guys.
This is why I love you, Julie, and we've missed you so much for those awesome analogies, because I feel that. I don't even know what those companies do. So, like, how do you find them? Like, where do you go and search for that kind of value?
it's a real struggle, right? When the actual creators and developers of AI are saying things like, hey, we're not exactly sure how this model works, but it's pretty cool. I'm like, it is pretty cool, but I kind of want to know how it works. And I do really want to know what the revenue applications are for this model. If we're going to invest as aggressively as these hyperscalers are, I don't think it's enough to just say, this is the kind of technology that makes us more efficient. There needs to be a bigger deal, a bigger business model built around this kind of investment. And that's my concern, is that it might not materialize in a way that we're hoping.
I am curious too, Julie. I mean, if we are seeing a slowdown in growth, and I'm talking about growth in some of these stocks and more importantly, their fundamentals here. Is there more safety out there outside of equities? I know some people have tried to gravitate into the bond market, and we did see movement there, but not necessarily wholesale. We've seen gold at record highs. But what exactly is sort of the defensive non-equity play right now?
Yeah, I think it's not actually just a function of the what is, right? Because for sure, fixed income is giving equity managers like me a real run for my money. When you have the kinds of yields that we're seeing, I think that really behooves the rest of us to recognize, wow, the ability to be a lender rather than an asset owner is quite compelling for a long-term investment for a lot of firms. And you're seeing that, right? You're seeing a lot of these private credit shops that are getting founded with very little expertise or background. And so I can see that as like a very compelling part of a good balanced portfolio. I think Europe too is kind of interesting, right? It had been this dog that no one was really interested in. And now suddenly we're talking about austerity for the US and spending in Europe. And that really changes the dynamics, particularly when you think of how cheap Europe was at the beginning of the year. It was a quite compelling value opportunity.
Yeah, and it's kind of amazing, too, to think why we've seen such a run-up in those names, because a lot of that has to do with U.S. policies, finally sort of, I guess, unleashing some of that fiscal spending that folks have been asking for. As folks pile into those stocks, and I was taking a look, I mean, some of the ETFs like SHLD and a few others that track global defensive stocks, I mean, they're on fire. I mean, you're doubling your money just in the last few months on that. But does that stick? Is that long term?
Well, I think, it really depends on each of the companies that you're looking at. I think those that were trading at valuation troughs, for me, there is a lot of sustainability and ability, because what we're talking about when we're talking about these defense plans that are happening in Germany and other parts of Europe is those are multi-year trends that have to take place, right? The underinvestment that was happening there was substantial, right? And they didn't need to. They were just standing, on the shoulders of the U.S. security and military spend, and now they have to do it on their own. So that, to me, is a multi-year trend. You can't pay, infinity multiple for that. There has to be a connection to valuation. But I think for a lot of those businesses that were trading at very, very attractive multiples, it made a lot of sense. Yeah. Going forward, I still think that you can kind of broaden beyond just what's happening in defense spend. I think there's more opportunity for investment broadly in Europe than just, what's going to happen with a military beef up.
All right, Julie, great stuff. We have to leave it there. Julie Biel, Chief Market Strategist over at Cain, Anderson, Rudnick. As we count you down to these closing bells, just about a minute till we get there. A lot of big questions on the day and on the week. And probably the biggest question I have to ask, Alex, is how many of the sweater guys did you actually date before you found your motorcycle jacket guy?
The sweater vest guy?
Yeah.
Never dated a sweater vest guy. I did date a motorcycle guy. So there is that, yeah. This is fun. Taking a look at the markets, though, you're looking at the S&P remained 2.2%. Like this, buying into the weekend seems very interesting to me when there still is so much headline risk. Yeah, and it's interesting, too, because we talk about the price moves. Bailey Lipschultz joins us right now. He's going to help walk us through the closing bells. He covers equities for us here at Bloomberg. And one thing that jumped out at me, 55.63, that was where the market opened today. That was the low of the day. The high of the day is right now where we speak. So wire to wire, this has been more or less an uptick from the first minute. And really needed, though. Yeah. When you look at how we had been trading this week and even over the last few weeks from that February 19th high, Mag 7 falling out of favor, so much uncertainty about who is going to be buying the dip, whether you want to rotate into an Apple or an NVIDIA, and we've seen a lot of big tech leading us higher today. Yeah, and big tech is out front, only marginally, but certainly noticeable on the day. The NASDAQ indices each, whether it's the composite or the 100, both up about 2.5% on the day, more than 400 points. Of course, on a weekly basis, they are still in the red, down about 2%. Similar story for the rest of the indices as well. The S&P 500 is going to
to finish the day higher by about 117 points, or about 2.1%, though on the week it is down 2.2%. The Dow Jones Industrial Average up more than 600 points on the day, or about 1.6%. They're going to finish the day down. The week, down by about 3%. And the Russell 2000, that's your relative outperformer. It's up 2.5% on the day. It's down 1.5% on the week, but based on the other moves in the other major indices, that is outperformance.
There are only like 48 stocks that aren't up within the S&P. So definitely an outsized rally pretty much across the board. Even the Dow transports are up by almost 2%.
On a sector basis, all 11 of the S&P sectors are finishing out the day in the green, led by tech, led by energy, and led by financials. And I have to do the glass half empty thing. On a weekly basis, only 2 of the sectors are in the green, and that would be energy and utilities, everything else in the red, with the biggest declines coming from discretionary and staples.
Yep, which raises the question, of course, is this sort of the washout and we can reset, or was this just a sell-off based on the fact that we were very overbought to begin with? And those have different implications, of course, for when you buy sustainably the dip. Bailey Lipschultz, kind enough to join us. He's a Bloomberg senior cross-asset reporter, and he joins us now. All right, winners, gainers, losers, what do we got?
The best performers, maybe not the best performers in the S&P 500, but when you look at some of the big rallies we saw, Mag 7, Nvidia up more than 5%, so much excitement around their AI event next week. Jensen is going to be giving a speech that really could kind of drive the market in kind of a dearth of earnings and maybe a lack of Fed speak. We also saw Apple rallying, probably a bit of short covering. I like to credit Ted Lasso. I'm a big fan of Ted Lasso coming back for a 4th season.
Okay, but is this going to go on too long? Like, is it one of those things where, like, they should have ended it?
I hope not. I mean, you can't...
You know what I'm saying?
You're putting bad vibes out there, Alex.
I'm sorry.
We're talking about gainers.
But it is a
Apple
girl team,
up.
so I am super pumped about that.
See, it's a big... Did you watch it, Romaine? I feel like...
I did not, but we are watching, what's the other one? Severance. It's on Apple.
Oh, Severance is also good.
So, yeah.
No, they're different.
So,
but, yeah. Ted Lasso makes you feel really good inside. I don't think Severance does that.
Okay.
Actually, kind of the opposite. But also another outperformer, Ulta stock rallying, 14%. This coming after beating expectations. Profit CEO talking about the lower risks of imports exposure.
Why were people discounting this stock? I mean, I understand, they had a couple of quarters or things, but, as Alex always points out, I mean, there's, some things that are recession-proof.
Invest in your face.
The only thing, though, you're still down 37% on a trailing 12-month basis. So even after a 13% pop, you're really just recouping some of those losses. So maybe you do have some of that discretionary spending, but at the end of the day, if you're weighing whether you want to pay premium for Ulta or shifting over and buying some discount goods, I don't know. Alex, I don't invest in my face, unfortunately.
What?
So,
well, you're still young. Believe me, you'll get to a point where you don't want to age gracefully.
It also feels, though, that all the retailers are getting hit by the same idea, right? So if things are less bad than maybe was out there, like that's enough for that kind of pop in a stock.
Well, the interesting thing to that point, it feels like we saw companies that were beaten down, low expectations, short covering, intraday pop. When then we saw a number of tech companies coming out and beating, but talking down forward guidance. And then you saw some of those big losses. But we're in such an uncertain environment that I don't think anyone knows.
I am curious, though, about some of the names that declined. I mean, on a day, we did see a lot of the retailers in the red. On the week, certainly, a lot of those retailers in the red. A lot of consumer discretionary names. And I'm curious as to what jumped out at you in that space.
If we're looking at some of the laggards, one that stands out, maybe not in discretionary particularly, but Abbott Labs, this is a company, medical devices, but they do also sell infant formula. So they were one of the biggest laggards among some of those larger cap companies. Them along with Reckitt, this coming after a judge ordered a new infant formula trial. So there's been some uncertainty around that. And obviously when you are dealing with potential lawsuits and what that could mean and some of those indecisions, that's really when you see some of these stocks lagging. But again, Abbott is really more well known for medical devices, a group that broadly speaking had been kind of seen as a safer haven given all the volatility. If you look at it on a 12-month chart, it actually was ripping just as all the broader markets were pulling back. So closing at 126 and change, but really was at the beginning of the year trading closer to, call it 113. So still trading in the green on a year-to-date basis.
Yeah.
Here's a stock. Sorry, go ahead.
Yeah, go ahead.
Stock Exponential Fitness. Down 38%. Never heard of this company, but apparently it owns like recreation centers, like boutique things where you do Pilates and stretching and cycling and all that kind of stuff.
The bougie gyms.
Yeah, I thought, are they out of favor now?
Out of favor. Well, weak outlook. I guess it comes back to kind of the K-shaped recovery, but missing expectations and kind of walking the street lower than maybe they were looking.
But this is a huge drop. I mean, we're talking about its worst drop ever. It's at a record low. And I guess the question is, I mean, I would think that their type of clientele, are like, the Alex Steeles of the world who are insulated from economic conditions because, they're always going to, make sure that they go out and get their, what is it, boutique fitness?
Yeah, it's an East Coast elite thing.
Okay.
I don't actually belong to this, just to
then
point it out.
Then she leaves and drinks Olipop and,
Yes, but I think to your point, high-end consumers, are they actually more recession-proof than we think? It also seems like the surprised analysts that they knew that there were issues, but maybe not to the depth of the issues that they saw. And it's also about upgrading infrastructure and processes, so a little bit more marketing on that side rather than just a drop-off in demand.
Yeah, and then also another loser for the day, Li Auto, EV company, forecasting revenue and vehicle deliveries for first quarter well below what Wall Street was looking for. We saw Xpeng, one of their competitors, also under pressure. Still feels like a very uncertain backdrop for electric vehicles. Obviously, Tesla has any number of headwinds, Musk-driven and otherwise, but there's just so much of a conversation around how expensive some of these can cost, and actually if there's demand to follow through, not only for the higher sticker price, but also just for the EV product as a whole.
All right. I want to take a quick look at yields because this is obviously going to be a big part of the story next week with the big Fed meeting. On the day, we did see some movement there. Yields did move higher across the board, up about 6 basis points on the shorter end of the curve, about 4 basis points on the longer end of the curve. We should point out, though, on a weekly basis, they basically went nowhere. I mean, they are higher on a weekly basis, but we're talking about 1 to 2 basis points. So despite all the volatility that we had in between, if you had just, went to sleep on last Friday and woken up right now, you would think nothing had really happened.
I could definitely do that, by the way. That would not be a problem for me. But it's interesting in the front end after with the UMich that you just had yields continuing to push higher, ending up by about 6 basis points. Like, are we going to talk about the Fed again and then what that winds up means for Wednesday and how do they have to upgrade their inflation forecast and downgrade their growth? Do they have to do that yet? And do you put money on trading that? It's
do you care about the Fed next week?
For me, what happens with the NVIDIA event is going to drive. I think that is more important than the Fed at this moment in time, obviously, because regardless what the Fed says and does, we still do have President Trump on again, off again tariffs, and that's driving so much uncertainty, though I am interested in seeing kind of how the Fed messages and what we could see because, again, whether they come out and say it or not, tariffs do matter.
And essentially, you bring up the NVIDIA event. We also get some interesting earnings next week that also could sort of shape people's perceptions of the economy. Nike and FedEx, two companies that are certainly at the center of consumer spending.
Yeah, and what are they? Two of the bigger in some of the indexes, depending on what you're looking at.
And they certainly have some weight there. But it gets to this idea: are investors are they focused on the economic data? Are they focused on the Fed? Are they focused just on NVIDIA and whatever narrative these companies are telling us?
Well, I mean that goes back to the debate around FedEx, though, and that whole Dow transports warning signal is
Dow theory.
Dow theory. The economy is not what it once was. So FedEx losing out to Amazon, for example, is that actually bearish for the economy? I don't necessarily know. Same thing with Nike. Is it kind of getting their story right?
Yeah, I woke up this morning. There's a whole story on the Bloomberg terminal telling me why I should care about Dow theory again.
I know, it's back.
Yeah.
It was a thing.
Yeah,
I mean, but if we have a manufacturing renaissance, right, and we reindustrialize here, maybe it becomes a thing again.
Maybe that's the long-term view that we needed.
You're welcome.
I don't know.
All right. Thanks, Bailey. Really appreciate you.
Yeah, all right. Thanks there to Bailey, helping us to wrap up a wild week. Alex, for some reason, is going to take off and start her weekend a little bit early. I'm going to stick around, though. We got a lot more coming up here on the big program, including what to expect from the White House next week. If we can answer that question, Godspeed. Henrietta, Treyz, Managing Director and Director of Economic Policy at Veda Partners. She'll be joining us in just a bit. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick, wrapping up another wild week on Wall Street, ending on a decidedly positive note despite a decidedly negative week. Stocks on Monday had actually had their worst day going back to December, here on this Friday having their best day going back to November. But the net effect of it all was deep in the red, down 2% on the S&P 500 as we did break below key moving averages on the week, and yesterday, of course, closing in correction territory. No one took it harder than the Dow transports. We saw a big drawdown here in some of those consumer discretionary names, particularly when it comes to airlines and a lot of the companies in the airline ecosystem, like Avis Budget and some of the car rental names. A lot of concerns here about consumer spending and how it holds up. If you're looking for any bright spots, you can find them in two spaces here. Oil and gas stocks staged a really decent rebound here after 3 straight weeks of losses, and that was largely led by Ontario, Conoco, and Valco, all at the top of the leaderboard, lifting the XOP up on the week by about 3.5%. Meanwhile, keep an eye on European defense stocks, one of the main ETFs that tracks that, up about 5% on the week. A 5-win streak right now for those names, as a lot of people now turn their eyes to Europe for some of the fiscal spending that appears to be being unleashed out there in the space. Meanwhile, back here in the U.S., some of the individual names to keep an eye on are indeed in that consumer discretionary space. On a daily basis, Ulta Beauty having one of its best days in weeks, and that was largely because some of the worst case fears did not necessarily appear after we got earnings out of that company. Nevertheless, you had names like Macy's down again here on the week, down again here on the day. Nike losing about 1% ahead of its earnings report next week. We're also going to get earnings out of Darden next week as well. Those shares did rally here on the day, up by about 3%. A lot did move the market here on this Friday, a Factor Friday. And Chris Cain joins us as he does every Friday over at Bloomberg Intelligence. And Chris, there were some really dramatic factor moves over the last month. Just talk about the ones that stood out to you most.
I mean, that's putting it lightly. It's very, very dramatic. I mean, the two that really stood out to me the most, I would say, was momentum and low volatility, and they're going in opposite directions. So momentum really just fell off a cliff over the last month. I mean, momentum, was the strongest performing factor going into about a month ago. It was the strongest performing factor in 2024. But over the last month, we had low momentum stocks outperform high momentum stocks by over 10%. That is not what you want to see if you're a momentum investor. So that's been bad. But low volatility has been really, really good. So over the last month, we have the low volatility stocks for the index down about 3%, high volatility stocks down about 15%. So if you're doing long, short, low volatility, you're up double digits over the last month. That's actually a 98th percentile result looking at all months going back 25 years. So basically one of the strongest short-term pops we've ever seen in the low volatility factor.
And so what's actually been driving that? Is that just basically people scared about what's happening in the economy? And I
think that's a big part of it. I mean, very logically, when there's turmoil, investors run to the low risk parts of the market, low volatility parts of the market. So that's rather obvious. But what's maybe not as obvious is when you look under the hood, the fundamentals of low volatility are actually very strong. So specifically profitability. When you look at the median return on equity for low volatility stocks, is over 5 percentage points higher than the index. It's only averaged about 2 percentage points higher over the last 25 years. So not only is it lower volatility, but it's higher profitability. And I think that gives investors some comfort.
We started off the show and we were talking about whether there were any silver linings out of this huge drawdown that we've seen. One person was pointing out all the inflows that we've seen actually coming into this market. Despite the fact we had some outflows this week, you're still sitting on something like $156 billion in inflows into the broader market. So whatever drawdown we had this week, not shaking a lot of people. Did you find any silver linings out of all this chaos that we've been through?
I mean, the only silver lining I would say is that, historically, it's very clear that high VIX levels have actually led to high future 1-month market returns. And you could think about this as just simple mean reversion, right? When you have high VIX levels, typically stocks have went down and they've, usually went down rather acutely. And you typically bounce back or mean revert after those periods. So, what you want to see is a VIX above about 24. That's been the signal to kind of go long stocks for the next month. We're below that right now, but we were above it in the middle of the week. So if you want a silver lining, I would say that's it.
Yeah, we closed 4 straight days above that 24 level, now back below it, right around just below 22. Chris Cain of Bloomberg Intelligence here for our Factor Friday. A lot of things moving in the market this week, and potentially even more could potentially move the market next week. That includes geopolitics. The G7 ministers are meeting in Quebec, Canada. We're going to check in with David Gura of Bloomberg on exactly what they're talking about. And we're going to talk to Henrietta Treyz over at Veda Partners here about the broader geopolitical backdrop and where it's going. That's coming up next here on The Close on Bloomberg. Canada is hosting the G7 foreign ministers meeting today in Quebec. It appears to be wrapping up as trade tensions and global uncertainties linger. David Gura is on the ground out there in Quebec, and he joins us right now to talk about, I guess, what we learned. Did we learn anything today, David?
Well, we certainly learned a lot just from the body language and interactions that we saw over the course of the last 3 days. But let's talk about the official agenda, which culminated in this communique that was signed to by all of the allies who participated in this meeting. And it was something that was by no means a guarantee. As of yesterday, when I spoke to the EU's chief diplomat, she was optimistic that they would all agree to something, but it certainly wasn't a done deal. It dealt with a number of items that were on the official agenda, including Ukraine and Russia and the Middle East. And I'll highlight just a couple of things to illustrate how much tension there was. We've heard a lot from European countries in recent days about the need for there to be security guarantees when it comes to Ukraine. That is not in this official document. There's an agreement for security assistance going forward. So not quite the same thing, kind of a more muted set of language. And then for the Middle East, for so many years now, the focus of the G7 has been on a two-state solution in the Middle East. We don't see that in this document. There's a nod to a way forward here for Israel and for Palestinians. But that language is absent. And I should say this is kind of the roadmap, Romain, that's going to be used at the Leaders Summit for the G7 in July. Yeah. We'll see if it's something that the president finds palatable.
And it's kind of interesting, too. I doubt that when they scheduled this particular meeting, they had any idea they would be swearing in a new Canadian prime minister. But that was taking place just about 500 kilometers away as Mark Carney, now the 24th Canadian prime minister. Does that change the complexion of how Canada is going to sort of deal with the United States, improve the relationship, maybe make it worse? What's the expectation?
So it certainly accelerated the proceedings here. So the foreign minister of Canada had to make her way back to Ottawa for that swearing in and for the first cabinet meeting. And I think Canadians are seeing this as a moment of reset when it comes to that relationship. And you've heard that from the new prime minister, from Mark Carney, when he spoke to reporters today. He talked about how the quality of conversations he's having on trade, in his estimation, are good. He's talked with the Trump administration and intends to do that going forward. And we've seen kind of a reshuffling of the cabinet. It's a much smaller cabinet than the one we had under Justin Trudeau. And there's a sense that any personal bad blood between President Trump and Justin Trudeau now vanishes, and Mark Carney can start anew. But as you know, Romain, this is going to be a very short-lived tenure for Mark Carney before there's going to be a national election. He's going to try to make the most of it before that election takes place, before he calls it. He's expected to make a trip to Paris and to London next week, and that kind of encapsulates the way that Canada and the Europeans are looking at one another here. They're used to having the U.S. as an incredibly close ally. They're kind of stymied by the fact that that's not the case anymore, and they're looking to each other for more support. So we saw that over the course of the meeting here over these last few days. European leaders giving an olive branch to Canadians, showing that they support them, they're in solidarity with them. That's expected to continue here as they kind of find a path forward here in light of this trade war taking place and, of course, ratcheting up as it has over these last few weeks, Romain.
All right, our man David Gura on the ground out there in Quebec here. Mark Carney, the new Prime Minister of Canada, set to immediately take a trip next week over to Europe to meet with his counterparts in France and the UK, as the market is completely wrapped right now by geopolitics. Henrietta Treyz joins us right now, Veda Partners Managing Director and Director of Economic Policy. I want to start with the interplay or the relationship right now between the major countries. And I know the United States at least appears to be on the outs with just about everybody that used to be our friends here. But is there any hope for a salvaging of a relationship that has existed for umpteen years compared to, I don't know, the 8-9 weeks that Trump has been in office?
Thanks for having me. Well, we do know that at the State Department, at any kind of military official level, and then certainly on Capitol Hill, there's robust support for NATO and for maintaining our alliances there. And so President Trump and his cabinet are very much in the minority, I think, in terms of institutional DC and historical climate around that. But it's obviously going to get quite a bit worse before it gets better. For example, my expectation is that we get tariffs on the EU, whether it's over their autos policy or the digital tax in the next couple of weeks. So there's a lot of escalation still to come.
I am curious about the whole tariff debate right now. And it's kind of hard to keep track because a lot of the tariffs that Trump has threatened aren't actually in effect, but we're already seeing a reaction to that. The narrative coming out of this administration, and we heard from Howard Lutnick on Bloomberg earlier this week, was this idea that this was short-term pain in the interest of some longer-term gains. At least that's what they're trying to sell to the American people. However, and this is the big but, Henrietta, is there's got to be something to blunt the impact of those tariffs. Are we going to get that?
No, absolutely not. One of the things that really concerns me is that we're not even halfway to done with the tariffs. You know, we have no discussion yet of whether we're going to pull out of the phase one trade deal with China, for example. We have no EU tariffs, as I suggested. We really still need to renegotiate the USMCA and much more besides. There's new Section 301 and 232 investigations across lumber and copper. I mean, the list is really endless before we even get to India and pharmaceuticals. So that's one piece of a lot more pain. Then you have tremendous amounts of federal deficit increases that we are about to tack on with this tax bill that they're working on in Congress. $4.5 trillion or more just to maintain the status quo. And I think that's the most important thing for investors right now. Members of the Trump administration were out trying to sell the American public on the idea that tariffs are tax cuts this week, which I can't pretend to endorse that kind of thinking. And most problematically, we do not have tax cuts in the works. We have $4.5 trillion worth of existing tax rates that we need to extend. That's not dessert. That's not a carrot. That is just a continuation of the status quo.
Well, that's what I'm curious about, and I don't even want to get into the whole debate about tax, whether this is a tax cut or, you know, a tax on consumers. We know exactly what a tariff is and how it works. What I don't know what works is this idea of what's working its way through Congress with regards to the budget process. And you mentioned how that right now what's being written into that budget bill is basically an extension of existing tax cuts. Do you think it's possible, though, that through the negotiations we could see new tax cuts, something on top of that?
There are three provisions on the business side that we would see reinstated. So things that have expired since 2022. There are three pieces worth about $300 billion worth of incentives for corporations. That's the R&D amortization period, the EBITDA to EBIT shifts rolling back, and potentially a year or two of bonus depreciation. Those are three pieces that will generate economic growth and score dynamically. But on the individual side, the president is, in my opinion, flailing when he offers tax elimination for every individual earning less than $150,000 a year. That is a non-starter in the extreme. But if you're talking about that level of extreme tax policy, you don't have a targeted agenda. So there's piecemeal things like no taxes on tips, but that's $175 billion, and you only get it if you get paid in tips. There is an idea to not tax Social Security, but that is not permissible if you're passing a bill with only Republican support, just logistically. So no, there's not a tax cut in the works on the individual side and a very limited one on the business side. And it's still going to cost $4.6 trillion plus in federal spending and deficit increases.
All right, Henrietta, got to leave it there. No doubt about it. The market's still going to be completely hanging on every word coming out of Washington, whether it's in the White House, Congress, or at the Fed. Henrietta Treyz, Veda Partners Managing Director and Director of Economic Policy. We do have some breaking news, this involving capital markets here in the U.S. Klarna, the Swedish payments firm, set to go public here in the United States. We are learning right now that the company has filed with the United States Securities and Exchange Commission for an IPO. Remember, this is a company that could potentially have an IPO of about $1 billion based on reporting that Bloomberg News reporters had earlier in the week. That company now making its filing. It's also disclosing some of its financials, saying that for 2024, its gross merchandise volume doubled to $105 billion. The company also says that it had 93 million active users at the end of the year and revenue of $2.8 billion and profit of $21 million. Klarna filing for a U.S. IPO. When we come back after the break, we continue our focus on tariffs and the impact on the alcohol industry. It's been a wild week for the wines and spirits industry, an industry grappling right now with the headaches caused by the unfolding of a global trade war. While the big booze makers like Brown-Forman's, like Constellation Brands have more resources at their disposal, smaller distilleries like Brough Brothers may be a bit more at risk. Joining us right now is Victor Yarbaugh. He's the CEO and co-founder of Brough Brothers Distillery down in Kentucky. It is Kentucky's first black-owned distillery. Great to have you here on the program. I kind of wish it was under better circumstances. I just want to get right to it here. I've been following your business, and I've been following just the development of everything you've been doing. And I had learned that you were actually working on an agreement just over the last few weeks to actually expand into Canada. My general understanding is that's not going to happen, right?
Yes. So again, thank you very much for having me. Literally, we were in the midst of a deal with New Brunswick, A and Biel. Literally, it happened. The initial call came in January, February. Things started to really go really quickly, and with anticipation for them to come in May, and solidify the deal. So as of right now, I spoke to our counterpart, and we're definitely it's been paused indefinitely because of the tariff. So this is where we are.
Well, give me a sense here of how much that disrupts your expansion plans. Are you sort of preparing for the idea that maybe whatever is going on between the United States and Canada politically will be resolved at some point soon, and then that whatever deal you are working on can potentially resume? Or is this something longer term, something much more structural?
Well, there's two things happening. One, I definitely hope the deal will be resolved like immediately, as soon as possible, basically. Anything long term for us, it makes it difficult as a manufacturer to be able to pivot. So for us, whenever we export, we have for 2025 for Brough Brothers, it's the year expansion. So part of that is expanding internationally. So these deals take between 1 to 2 years to really complete. The Canadian deal in particular was one of the fast-track deals because they were looking for a new supplier, and we were looking to go into Canada. So we were actually able to kind of meet and get things done pretty quickly. So for us, we have to now figure out whether or not if this is going to be something that's going to be long-term, or if it's just, hey, we can get this reconciled, let's get a new deal in place, let's start back to ground zero, and let's be friends again.
Well, okay. Well, how do you plan, though, in this environment? Because my general understanding of the distilling process, it's a pretty long-term process. I mean, how long does it take from, when you take shipment of the grains to the, you actually get it into a bottle on the shelves? How long does that take, and how much more difficult it is to plan out how much supply you should be taking and how much output you should be doing?
Sure. So really the planning goes on years in advance. So in particular, if we wanted to just put something in the barrel right now, it would take us roughly 6 weeks from getting the grain to actually storing it and distilling it and actually manufacturing, putting it into the actual barrel. From there, our aged product would then go into a bottle, and depending on the age of the product, so we would have aged. Our Brough Brothers Kentucky Straight Bourbon is that's 2 years. Then our Three Kings is really old. So depending on the age, we just pull various barrels. Once we pull a barrel, that takes about 2 weeks, and to bottling takes about another week. So you're looking at about 6 weeks from process to get something in the bottle, and then to actually export it, it takes another 2 months basically. So really, 12 weeks easy. On the short end. That's on the short end.
If you don't have the opportunity to expand internationally in the traditional markets that we see a lot of American whiskey and liquor makers take, meaning Canada and Europe, are there other countries that maybe they have enough demand that could pick up some of that slack?
I believe so, and we're currently, reviewing those opportunities. So oddly enough, we've had people reach out and say, hey, we're seeing what's going on with the EU and Canada. Hey, give us a try. So we literally had an email from Macedonia. So, it's one of those things where we're constantly from Macedonia. We're literally, it's that serious. So people want their whiskey, and we have to figure out a way to the extra demand or supply that we had, figure out where we need to send it, basically. So whether it be Brazil or Colombia or India, we're definitely looking at other opportunities to figure out where we can send this bourbon.
Setting aside the trade and tariff issues right now, what had demand been like, not only just for your brand specifically, but overall for American whiskey and spirits?
Well, overall, in general, I think the demand in between Canada and Europe is fairly strong. It makes it quite, I guess, between those two countries or continents, it's literally maybe, I want to say, 20% export market in terms of sending product there. So it's a lot of product that goes to those two territories. I'm saying generically territories. So for the industry as a whole, it's definitely cumbersome to be able to have to figure out exactly what strategy they need to implement to be able to be successful.
All right, Victor. Well, I wish you the best, and we'll check in with you in a few weeks and see how things are going. Victor Yarbaugh, he's the CEO and co-founder of the bourbon company Brough Brothers. And it's not just liquor brands worrying about tariffs. Equipment makers have concerns of their own. Companies like Bartesian, which makes cocktails using capsules. Pleased to say joining us here in Studio 2 is Ryan Close. He's the founder and CEO of Bartesian, and Erin Lichy, she's the co-founder and CMO of Mezcalum, which is Bartesian's first brand partnership. All right, I'm going to save the hard questions for a second because, first of all, I love this product. For those of us who've been, always had trouble kind of making our own cocktails at home, the whole idea behind this product is the idea that it kind of takes the guesswork out of it, right? The expertise. I don't need to be an expert on cocktail culture to actually make a good cocktail.
Well, you nailed it. It's, Bartesian's about being able to have extremely great cocktails without having to suffer through finding, the correct bitters, liqueurs, juices, having sometimes obscure juices in your fridge for weeks on end that you're not sure if you want to. And so the idea is it's a simplified way to experience that incredible cocktail moment with your partners, your friends, at a push of a button.
And how did you get involved in this, Erin? I mean, obviously, I know you've been working with Mezcalum for a while. I mean, how did this end up in Bartesian?
Mezcalum. Yeah. I think you guys approached us. And, we just started talking and they said, would you like to do a collab with us for a pod? And we said, as long as it can taste like the cocktails we make at home that are fresh. And the cocktail is so delicious. I can't even believe you guys nailed it like that. I think we're almost sold out. It's been so incredibly successful. It's really, really cool.
Are you primarily selling direct to the consumer or are you going through the retailers as well?
So Bartesian is selling all the pods, so I'll let you speak to that.
That's right. So we have hundreds of thousands of users in the U.S., and so there's quite a community of cocktail enthusiasts that tap in, and they're looking for us to come up with new, innovative cocktails that they want to try at home. Sometimes, they don't want to go spend $18, $25 at a bar or a restaurant, even more here in New York.
Yeah, have you been in a New York bar lately?
Recently.
It's a bargain.
So,
really?
The ability to try these incredible new cocktails at home for a couple dollars. And so, again, to answer your question, primarily direct to consumer through our website, Bartesian.com. But they're also, our capsules are also on Amazon and Total Wine and More, et cetera.
I do have to ask you about what's been going on with tariffs and trades. I mean, both of your businesses independently, whether it's Mezcalum or Bartesian, I would think would have some international exposure. With regards to just sourcing the materials to make the Bartesian machines and everything that goes into that, are you dealing with any disruptions from that because of the tariff and trade issues?
I got to throw a big shout out to my team, who's really, we kind of saw this coming. It wasn't a big shock to us a couple of years back. We anticipated tariffs being a thing, right? I think that happened with the previous Trump administration. It was, so we knew, whether it wasn't coming in, they were going to do it again through that administration or someone else. It was going to happen. So, we made shifts to our business model to ensure that we're not, having to jack our prices up once this happens, and I think that's important.
So what about you, Erin? I mean, obviously, when we talk about, mezcal and tequila and things, I assume that's all being sourced from Mexico. Are you concerned right now?
I mean, I'm a bit concerned, although my husband, the other co-founder, is not concerned. He's an attorney, and he came up with a lot of strategies to protect us. One of the things we did was we bought all of our dry goods in, bulk, really, and we have everything stored in our distiller.
And they keep for a while.
And they
Is that
keep
the idea?
it. Yeah, they keep for a while. And also there are other sort of creative solutions that we've come up with to mitigate risk, and we will not be raising our prices. That's kind of what's special about being a smaller brand at this stage. We're a little bit more nimble. We're not like a corporate conglomerate that has to raise prices in order to keep up. So that's one of the benefits right now of us being a little bit smaller.
What's been consumption like overall? I mean, I know there have been a lot of talk about that younger people weren't drinking as much alcohol, certainly not as much hard alcohol as maybe the older generations did. Is there a trend line in there that you have to navigate?
Well, the trend actually lends itself to the popularity of mezcal because mezcal really is the best version of alcohol for you.
Well,
so, it's like doctors will say, we don't recommend you drink, but if you will, drink mezcal. Yeah, it's true, and I'll tell you why. Bring that up. Ask her. I'll let you know. I'll tell you why. So tequila is obviously an agave spirit as well. However, it's only made from one type of agave, and also by Mexican law, it only has to be 51% pure agave, which leads obviously 49% of additives that are available that can be put into the product. Mezcal, by Mexican law, must be 100% pure agave. So it's additive-free naturally by nature. And a lot of people who are into wellness are, like, if they're going to drink, they're focusing on additive-free liquors. And with mezcal, you know that you're going to get additive-free.
Are you selling primarily to U.S. customers, or do you have
I mean, right now, we've only been around a year. So we're in the Northeast. We're, thank God, beating
so
our
you don't have to
budget.
worry about export markets or anything like that? You're
not right
at that
now,
stage.
no.
What about you? Do you have to worry about that?
You know, in terms of the alcohol, I think folks and consumers are trading up, right? They're looking for a more premium product and a premium answer, and that's why, you know, we developed Bartesian to begin with. It's, you know, putting in ingredients that have no artificial colors and flavors, really nailing the quality, and ensuring that folks, when you're going to have a cocktail, you know, we're not about having more, we're having better, right? And so that's what Bartesian's all about.
We only have about 45 seconds. What's your favorite cocktail?
I love an old-fashioned. I'm a simple guy. You know, I bartended through college. I couldn't even make a good old-fashioned. I was terrible. The sugar would be at the last sip. So ours is a banger.
Erin, how about you?
I love, this is a unique one, a Maximilian Affair. Try it.
That's new to me.
So good.
Okay, all right.
Mezcal and Saint Germain. So good.
Saint Germain. All right. You know, I used to be a Manhattan guy, but I've transitioned to whiskey sours now.
Oh,
like
really?
The sweetness.
Oh, you do?
So,
we have to get a cocktail.
So we'll say we do.
Not yet. Soon.
Yes, let's hold off for a few more months. Ryan Close of Bartesian, Erin Lichy over at Mezcalum. Our thanks to both of them here. Coming on the big program, wrapping up a wild week on Wall Street here. We take a look at some of the weekly gains. Well, they're not gains at all. Losses across the board, despite the rebound that we had here on the day. The NASDAQ down 2.5%. The Dow down about 2 to 3% here on a weekly basis. Believe it or not, though, the outperformance actually came from two interesting areas. The Russell 2000 small caps outperforming the market for the first time in several weeks. And I want you to take a look at treasuries there. There's an index on the Bloomberg terminal that tracks all of the total returns in the fixed income market, whether it's treasuries, investment grade, and everything in between, that has outperformed equities now for 6 straight weeks. This is The Close on Bloomberg. We've been talking a lot about inflation on this program for the last couple of weeks. Rising cocoa prices, rising egg prices that pinch consumers. They're also maybe pinching companies as well. One company has a firsthand perspective on all this is Levain Bakery. It started out as a small bread shop on the Upper West Side of Manhattan, and it's now has expanded over the past 30 years to 16 bakery locations and counting across the U.S. And now I'm told you can actually find some of their products in grocery stores. I'm pleased to say that the founders of Levain join us right now, Pam Weeks and Connie McDonald. Great to meet you guys both here. I feel like I've eaten there so much, I feel like I already know you, even though I've never actually met you. First, I want to just start talking about just the dynamics of a bakery business overall, because I was always under the understanding that the margins in that business were already relatively tight. Is that true?
That's pretty true.
Yeah.
Yes, yeah. But one thing we've always been really conscious of is sort of managing our costs, and we've been really thoughtful on how we pick our real estate and things like that to keep things under control.
And how do you do that? So we talk about real estate, obviously you have labor costs, and then of course you obviously have the food costs to make the final products here.
Right. So as Pam was saying, it's a really great point, because the food costs and the labor costs are things that you really, there's no way that you can not deal with the fact of the reality of what they are. However, your rent, you really do have a choice of where you can decide to be. And we've always subscribed to the idea that we love being a little bit off the avenue, just a little, to make it for a couple reasons. Yes, the rent is much more affordable, and it also has that kind of neighborhood feel to it. So it's kind of like super on brand for us. But when we're not like working every day to kind of cover our rent, because you're right, the prices, the egg prices, that they're constantly changing. But if we can keep that rent.
You can't control the prices of your ingredients at all, but the things you can control, you try to control.
So with rent, so we're not going to see a Levain on like Fifth Avenue or at the airport or one of the high rent districts or something.
We did just open in Flatiron, just off Fifth Avenue on 18th Street, and it's great.
Okay, that's the lower rent part of Fifth Avenue. That's the side of the, you have the really luxury part and then the slightly less luxury part of Fifth Avenue for our viewers. I do want to though talk about the actual ingredient costs itself, because I mean obviously everyone, eggs have kind of become a barometer for inflation in this nation, because for most consumers, that's kind of what we know when we go to the grocery store. We see the price of eggs or see the fact they're not even on the shelves. And I just wonder, I mean, I immediately think of a bakery, and I think you guys are getting hit by everything, right? I mean, cocoa prices are up, sugar prices, eggs, I mean, basically kind of the three staples that go into a good chunk of what you bake, right?
Yeah, well, we've been doing this for 30 years now, and over the 30 years, we've seen a lot of price fluctuations. There was actually one holiday season where the price of butter more than doubled and just really killed us. I don't think we made any money that season, but we held steady with what we were doing. We're not going to change our ingredients or raise our prices. And, we're trying to be aware of what's going on, but you can't control things like that.
Are you able to stockpile any of those? Because I know eggs won't
Well,
keep, but what about
I was
some
going
of
to
the
say,
other-
we do have an incredibly talented team that does work on procurement and, having, when you're purchasing things so far in advance and you've got like some things locked in where we are fortunate with that regard. So it's a really important part of what we do.
I mean, given your size, you're still a small business, but given your size and the expansion, do you have a little bit more power to negotiate on pricing now than maybe what you would have had, 20 years ago?
Yes,
for sure.
We have a lot more.
Absolutely.
Yeah, which is really helpful.
So they're willing to work with you in some cases or another. It's interesting, too. And then on the other flip side is sort of the price to the consumer. And you just said, Pam, that you had no intention of raising your prices for the consumer. Why not?
We want to keep what we make is an affordable luxury, and we really want it to be accessible to everybody. So we'll do whatever we can to hold our prices.
That's good. But even if you do see any kind of margin pressure, you think it's worth keeping the prices where they are in the interest, I guess, of just keeping your customers happy? Is that the idea?
I think so. I think, of course, if things got absolutely insane, we might have to take a step back and reevaluate things. But as it stands now, we can still deliver the same product that people have come to depend on us for and really love. And so our plan is to stay the course with that.
As I say, we didn't open a bakery to make a lot of money. We opened it because we wanted to do something we love. So as long as we're covering our costs, we're not concerned.
And that's interesting, too, because if we do, there's been a lot of talk about maybe potential economic softness and consumers making a lot of hard choices about what they are willing to spend on. And, let's face it, I don't take offense, but no one needs a cookie, right?
No.
It is a discretionary item. And I know you bake other things like bread and things that maybe are a little bit more of staples. But is the idea that even if there is an economic slowdown, people will still spend on those types of items?
We believe that they will.
Yeah.
We've seen,
you've been around long enough to go through
seen
economic.
a lot of different things happen, and people come in for our cookies to bring as gifts to comfort people, as a congratulations. They bring them in with their friends and family and come in for themselves.
So what's next for this company? You guys, I think back that tiny little shop. I don't know if it's still there on 7th.
It is still there, yes.
It's a little, basically shoebox of a store. And now you guys are everywhere. And you've kept your store footprints relatively small. I've been in several of them. They've all been pretty small, which you have to do in this city if you want to make a living. But what is the plan for expansion? How big do you want to get?
Not too big. We're trying to focus on remaining who we are. We want to bring what we started on 74th Street to any new place that we open. We want to be your neighborhood bakery, and we want to become part of the neighborhood.
I have to ask you just real quickly, we only have about a minute left for either of you here, about the expansion into grocery stores. There was a lot of backlash online when people said, they're selling it in the grocery, Levain has jumped the shark now that, I can get them in the grocery stores instead of having to go to the bakery. What do you say to people like that?
Well,
I think you want to take it. Connie looked at you like.
Well, actually, they're not in the
interesting twist to that.
They're not in the grocery stores right now. We had to take a pause because
this is one place where pricing actually did affect us.
Yes.
Oh, really?
Yeah.
It did.
Okay.
Right after lockdown, when supply chain prices were just going and really to the point where we could no longer afford to produce that product at the level at which we wanted to produce it at a price that we thought was fair. We thought we'd take a pause from it. So that is one place where we did do that.
Interesting. Do you think you may try to re-enter that space sometime soon?
I wouldn't
not
be surprised.
soon, but sometime in the future, I would love to. Yeah.
It was a hugely successful product, and I would not be surprised if we saw it again sometime.
All right. Well, I hope to talk to you guys again now as you guys continue to grow and expand. Connie, Pam, it was really great to meet you. That is Pam Weeks and Connie McDonald. They are the co-founders of Levain Bakery. All right, a lot more coming up on the program. We're going to set you up for what to watch over the next week. This is Bloomberg. Closing out a wild week, the market has a lot to look ahead to next week, particularly in the economic space. Retail sales, home sales, and a big Fed meeting midweek. Anna Wong joins us right now from Bloomberg Economics in our D.C. bureau. And let's start with the Fed. Anna, I know they're not going to change rates, but they do have to give an update on their economic projections. What is your expectation?
We think the projections will carry a stagflationary light flavor, so they're going to revise up inflation estimates, but also revise up unemployment. And more alarmingly to Wall Street is that they are going to perhaps knock down the number of rate cuts expected for 2025 in the dot plot.
I'm also curious about this retail sales number. We get this on Monday, and I know in the prior month for the January numbers, they were down by a lot, but there were a lot of distortions there. What are we expecting to see out of that February number?
We're expecting a rebound in the retail sales. So one of the driver of the plunge in January was the frigid weather, and that had stopped many potential shoppers to buy from buying cars. So in February, that should rebound. So on net, we're expecting a 0.2% increase for control groups, which exclude all the volatile consumer categories, which means inflation adjusted retail should be flat.
All right, retail sales out on Monday. Anna Wong of Bloomberg Economics, a big Fed meeting on Wednesday. We do get earnings next week as well. A lot of names like FedEx as well as Nike. A lot to parse, and we hope you join us next week right here on The Close. For all your politics news, stick around. Balance of Power is coming up next, right here on Bloomberg.